We're live. Come on in, everyone. Join us. We're talking about the tough day in the stock market. Techs got crushed, and people have no reason to hold off tax loss selling anymore because we're in a new year. Let's see if a few more people want to jump in here. All right. Thank you so much for joining me. It's time for Be the Boss of Your Money. I'm Mitch Goldberg, your host. This show is all about personal finance, investing, you name it, we talk about it. I take 30 plus years of my experience as a financial advisor. I take lessons learned, situations, questions, challenges that clients have overcome. And I take all of that and I share it with you here. But today, the urgency in which investors were unloading the mega cap tech stocks really reminds me of a time gone by. The year 2000 time, that is. We're going to talk about that, what's happening. So let's roll the quick intro and we're going to get into a good show. While you're watching, you know the deal. I love hearing from you. So if you just want to say hi in the comments, I'd love to hear from you. If you have any questions about what we're talking about, personal finance, whatever, hit me up in the comments. I'm here for you, and that's what this show is all about. So go ahead. Here we go. Boy, today is like a 6 cup of coffee day. You know, like you've heard the expression 4 alarm, 5 alarm fire. Today's like a 6 cup day. It's just one of those days. It's like dreary, freaking cold out, New York. I haven't seen the sun in like a week and a half. It's just like, it's like that depressing part of winter, but the holidays are over. So it's like now we have to wait for like something else, a new holiday. But then there's Omicron and everybody's stuck inside and it just sucks. It's like everything sucks. This goddamn mask. Here we go. It's like you guys have a problem. If you wear glasses, you know what I'm talking about. You take the mask off and it just tugs on the arm of your glasses. Like, look at my sunglasses. Look how stretched out they are. You see that? I can't even wear these things anymore because when I take my mask off, it clips this, catches the side of the arm and it just pulls them off. I do that like 10 times a day, saying I will now know not to do it and I'll never do it again. But then it just happens. But I digress. We've got a little market situation on our hands, and it's continued from last year. So let's give you a little bit of background just in case you were not joining us in the last, let's say, year or two. I see a new face out there. Hi, Isabel. So nice to see you. And I'm so glad you are taking the time to join me. Isabel is a longtime market watcher, and pleasure to see you today. Well, pleasure to be seen by you today. Okay. Josh is out there as well. Thank you, buddy. Thank you for the sweet emojis. You're the best. You're a sweet guy. So what we've been talking about is this. Man, oh man, I know people hate like I told you so stuff, but we talked about the techs, the Zooms, the DoorDashes, the pandemic stocks that took off because of the pandemic, because of the conditions that led to people working from home, staying at home, and these stocks took off. Peloton, for example. And we're like, this is crazy. This is out of control. A lot of these are still, they're revenue stocks, but they're not really concept. They're not really earnings plays yet, but they tanked. We talked about that. And it's great when they go up, but I just never seem to see people get out of these. I've been there myself. I was in the late 90s, 2000 tech bubble. And let me tell you, it's not easy to get out. People don't walk away until they're wounded. You know what I mean? If you don't know what I mean, you don't want to find out what I mean. So you just want to listen to me for a minute, all right? And what I've been saying is you're seeing, like in 1999, 2000, you're seeing the smaller companies' stocks go down. The ones with no earnings, they're just getting mauled. Again, the ones we talk about here all the time. I'll put them on the screen in a moment. But it's the Zooms, it's the the DoorDashers of the world, right? It's the Pelotons, the Teladoc, so many of them. All right. But while investors take money off out of those and those stocks go down, they're putting the money into the mega caps, the Facebooks, Microsoft, Apple, which hit a $3 trillion market cap. So you don't realize the damage underneath the S&P 500 because the S&P 500 is doing well, because money is leaving non-S&P 500 stocks going into the top 4 or 5 biggest stocks in S&P, which are all tech. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And that happened in the year 2000 until you finally got to March of 2000. And there was just no more money left to go into the mega cap, super large cap tech stocks. And they finally started to crack. And when they finally started to crack, it just brought the whole NASDAQ down. Now, in 2000, the NASDAQ went from peak to trough. It didn't hit the trough for about 3 years later. So people think of like the tech wreck like it was a one-day event, like, oh, you just ripped the Band-Aid, it was off, and everything came right back. No, it was 3 years of pure hell. That's what that was. I see a similar situation unfolding where money went into the mega cap stocks, and now they're starting to give it back. Is this a trend? I'm not saying it's a trend. It's too early to say it's a trend. But I'm looking at the ingredients that could make it into a trend. So I'm looking at rising interest rates. First and foremost, right? I'm looking at a stronger economy. A stronger economy means, that sorry, I put that there. We're in a stronger economy. That means you don't have to rely on the secular growers, the companies that are going to grow no matter what. If you have a slow economy, you just want to buy Facebook and Google, / Alphabet, because they're growing no matter what. So that's where you can get growth in a no growth environment. But with growth, now you could buy steel stocks, you could buy automobile stocks. There's so many industrials, energy, financials, consumer discretionary. So now, and when they have growth, they're going to have a lot of growth. And since they haven't had growth for so long and they haven't really rallied for so long, that's where money starts to rotate. Where does the money come out of? It's coming out of the areas that performed very well when the economy was slow and when we had very low interest rates. I mean, interest rates are still low, but it's all relative. I mean, you can't look at interest rates today and compare them to 20 years ago. You've got to take a look at interest rates now and compare them to like 3 months ago. All right. If you do that, interest rates are up. I mean, the 10-year the 30-year mortgage rate is the highest it's been in years. It's still like 3.3%, which if you're like 45 and over, that still sounds like incredibly low. But if you're 35 and under and buying a house, you're saying to yourself, I can't believe how high mortgage rates got. My first mortgage in Jericho, New York, was 8%. And that was unbelievably low. Like, we couldn't believe we got such a low rate. Like a year later, they're down to 6, and a year later down to 4. So they kept going down. But anyway, that's what's happening in the market right now. And it's not a little something. I don't think this is it's like crazy. I don't think this is like a one-day wonder where we just have a couple of bad days and the NASDAQ get the selling out of the way, and then we're off to the races. And that's what people constantly expect from this market. You buy the dip, and we're off to the races. Zoom goes down, Zoom stock, buy a little, right back up. And it's buy the effing dip is how all the memes say it. And how's that been working for you lately? It just goes to show you just buying the effing dip is not exactly a strategy. It's a strategy if you dollar cost average and you're investing in a diversified portfolio. Maybe if you're using index funds. By the way, diversification is a strategy that, as you know, we use it to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I just get these disclaimers. I work them right into the conversation. It's like, wow, I'm so good at this. So that's what's happening. Higher rates, knocking down stocks, stronger economy, building up industrials, economically sensitive stocks, because they have the opportunity to show growth. That's what's happening. And it looks like it's a pretty sticky trend. And if Omicron couldn't slow down the economy, then what could? I mean, it's. I have to tell you, as bad as we think it is, and as much as you see like the schools not opening, the colleges delaying their second semester, and all the local school districts everywhere are wondering if they should go full remote or just have a week delay or whatever. The stock market is already looking past that, and for better or for worse, we've moved past it, and we have ourselves a pretty heavy duty cyclical market. So let's take a look. Let's go to the put myself in the share screen, and let me get rid of the social media icons over here. Okay, here we go. So the Dow down almost 400 points, NASDAQ down 3.3%, 500 points, and that is the worst day for the NASDAQ percentage wise in 11 months. S&P off almost 2%, and this just continues into what we saw. Gold down a little bit. What I've been saying about gold and about crypto, the worst thing for gold and crypto is a central bank, in particular the Federal Reserve, that has gotten religion about fighting inflation. We're going to talk about that in a moment. 10-year yield up to 1.7%. Man, I mean, last year everybody was calling for 2.5% on the 10-year, including myself, and it didn't get there. Now everybody's saying it's going to be hard to break 2%. So I'm saying, you know what? We'll see 2.5% this year. The VIX was up nicely, still under 20. But if, like I always say, if the VIX goes above 20, we've got another leg down. Another one bites the dust. Hey, 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 another one bites the dust. Russell 2000 down 3.3 points. I thought the Russell 2K, by the way, that is the small cap index. And didn't we hear that the small cap stocks were going to have a good year this year? No, sir. They did not work out. Let's take a look at crypto. Okay, so crypto gets crushed, and it keeps getting crushed. And I don't expect anything great out of crypto, and I'll tell you why. Like I said with gold and crypto a second ago, crypto is thought of as a way to beat as a way to win the currency war over the fiat currencies. Fiat currencies like the dollar. Fiat currencies are basically money supply that is paper, like dollars, euros, even though it's really electronic, but you get the point, where a central bank can create more or destroy the dollars or whatever the fiat currency is. And a lot of people don't like that because it means when push comes to shove, central banks lose their discipline and they print dollars or whatever currency they can print to get out of a tough situation. And it works for now, but there could be severe long-term consequences like the devaluation of the US dollar. So let's say, you've got several $1 million in the bank, several $1 million net worth. You have to wonder what's really happening to your net worth with inflation. Now, yes, there are plenty of people in the world who have so much money that they'll be ahead of it no matter what. People who own real estate are staying ahead of the curve. So this is why you want to put your money in assets. So when the dollar gets hurt because of inflation, people feel that gold and real estate and stocks, for that matter, are better places to keep your money than just in a savings account or some other cash equivalent. Obviously, the stock market is pretty volatile. Real estate, I hear what people say. Well, if you look at REITs, it could be pretty volatile. But generally speaking, if you buy a building, you're buying it, you're owning it, you're renting it out, you're fixing it up. It's. I'm not talking about house flipping or commercial real estate flipping, and not what I'm talking about. And Andrew, surprised the VIX is still under 20. I am surprised also. I have to tell you, and I don't know why it's under 20. I mean, you always know why the day after. But the day before, you kind of just have to give your best reason. My best reason that the VIX is under 20 is that hedge funds, institutional investors who don't really believe that we're seeing something much worse. Maybe we'll have a couple of down days and we'll be back to the races. My own view is that the VIX is going above 20, and I'm with you. I'm surprised it didn't do it today. So, but crypto is down. So you see this crypto is down across the board. People are like, oh, I finally got into crypto and now it's down. And it's down a lot. Like I realize that if you bought Bitcoin 2 years ago, you're still up a lot. But there's an awful lot of Johnny come latelys because money goes where money grows. People jump into Bitcoin and they all got hit across the board. Let's take a look at some of these. I don't know why I like to look at the Doge down to 16 cents. I look at Doge because I'm still pissed off that Elon Musk touts it in social media and on Saturday Night Live, and people jump into it and then they lose their money. And this is why, if you're in a position of influence, you really have to be careful, um, you know, with what you say, because I understand we're all adults and we have to make our own decisions, but not everybody has the sophistication that Elon has. And it's a shame that to see people lose money because they believe in Elon Musk so much. I'm not taking anything away from the man as accomplished. I just don't think people with a big bullhorn should be shouting out to buy very speculative things. I digress. So the worst thing for crypto is a Fed that's got religion about inflation and now is getting discipline. The whole point of crypto, though, we're talking about fiat currency. The main reason to buy crypto was because of the lack of discipline on the part of central banks when it comes to managing their currency and printing currency to dig themselves out of every financial calamity. So therefore, Bitcoin, for example, crypto, there's a finite amount of Bitcoin, for example, something like 90% of crypto of Bitcoin has been mined. There's not an infinite amount to be had. There's a finite amount. And that's what investors want because of the irresponsible behavior of central banks that could spark inflation and other problems that have yet to be discovered. So it's like we're saying, we know there's going to be a problem. We just don't know what it's going to be yet, but there are always unintended consequences. You don't get to eat as much sugar as you want without having some kind of unintended consequence down the road. So going with the sugar analogy, we could talk about down the road, diabetes, high blood pressure, things like that. So but since the Federal Reserve is now all of a sudden talking about not only it's actually already lowering its bond buying, and it's going to be finished in a couple of months. Now, in March, it should be finished. Now the Fed is signaling their first rate hike right after they're done with ending QE. So maybe we could see a rate hike in March. And now they're also talking about scaling down its nearly $9 trillion balance sheet. You take all three of those and people start to wonder, can the stock market handle that? Because the stock market is trading at a high valuation historically based on liquidity, low rates, profligate Federal Reserve, printing currency, printing dollars. And wow, we're taking that away, a little too quick maybe. And we don't know if stocks can really handle that. So it's spooking people out a little bit. And it is a pretty freaky thing. It's freaky, like super freak. I should put a super freak thing in here. I don't have one. I have a video. Here's a video. It's tricky. It's tricky. It's tricky. But I don't have super freak. I have what have you done for me lately? You ready? You ready for this? I'm having fun. So that's why crypto is going down, because the reason if you bought crypto because you think there's going to be endless printing of dollars and the Fed has lost all sense of reality and it's going to print and print and print. If that's why you bought crypto, then on the reverse of that, if the Fed has become disciplined and now is going to withdraw liquidity from the system, the opposite of printing is you're going to take liquidity out of the system, the financial system, then wouldn't you sell crypto? And that's exactly what's happening. And these are legit reasons. These are not just reasons of sentiment. This is how markets work. Like right now, as much as it could suck for you, this is how markets are supposed to work. Like this is like we're not in Disneyland anymore. This is how markets work, and it's actually in a way it's interesting, and it's oh, you're not going to like this. It's refreshing though that the stock market is acting the way it should. It's just that the way it should act right now is not in your favor. Okay. Any questions out there? Comments? Oh, I'm not allowed to ask for comments. I can only ask if you have questions, but I could always say if you have words of wisdom, words of encouragement, word to your mother, I'm right here. All right. So let's just take a look at some stocks, and then we're gonna get going. All right. And I'll do another share screen. Share screen. Let's go to the watch list. So let's take a look at some popular stocks. So Honeywell was up, Caterpillar, Wabash National, John Deere. It wasn't everything down. Boeing was only off 56 cents a share, but these industrials have real stories behind them, real earnings momentum behind them. 3M. Look at 3M down from 208. A lot of these stocks, you see this red over here. You see like the red in Caterpillar. That is the distance. That measures the distance from their year high, their 52-week high, to where they are now. There's a lot of catch-up plays at Honeywell. I mean, there are a lot of catch-up plays. I was just looking at Honeywell last week at like 190, 195, and man, oh man, that's a nice move for Honeywell. So let's take a look at what else is going on here. I want to take a look at some of the ETFs that you guys have all drooled over when they were hot. Okay, ETF watch list. BITO. That's the I call that the bullshit Bitcoin ETF, and I say that because it's not really a Bitcoin ETF. It's an ETF that invests in futures that track Bitcoin. And futures don't necessarily do a great job of tracking an underlying asset. Plus, they have something called time value decay. And when the when the Bitcoin goes down, these will go down more. And even if Bitcoin just stays flat, the futures will go down because they have an expiration period coming up pretty quickly. And BITO invest in short-term futures. It's all written out in their offering documents. So down to 27 from 44, and people are like, oh, I'll buy that. That's a good idea. It's just a good way to get some crypto exposure. Ugh. I say ugh because it's like I want to vomit when I think about people buying that. Don't buy it. If you have it, hey, whatever. Okay. I have to be careful what I say. I don't like when I say I don't like something that purports to track something when it doesn't really track something. So that's what I'm saying. I'm not saying don't buy this particular security. Okay. It's hard for me to cross my fingers now that I'm in my 50s because I have a little arthritis. Do you ever notice that if you're older than 50? Okay. But I'm not saying don't buy it. I'm just saying I don't like to buy securities that don't track what they're supposed to track. Boom. The SPAC. This is the SPAC ETF, SPAK. We did a whole show on this. 35 to 20 just got crushed. The meme ETF. What the hell? I mean, this company, Roundhill, they have a great way of jumping on whatever the hot trend is and coming out with an ETF for it. And you know how that works. They're hot, and then as soon as the people move on, investors who bought into this stuff are left holding the bag. So look at that, only from its high to its low. ARK Innovation Fund, Kathy Wood, from 159. This is a new year low today. It hit, okay, down 7% today. That's a new year low. And Meta, like this one of the all-time dumbest ETFs. It's just Meta means this ETF. I did a whole show on this 2 weeks ago. It's a tech stock ETF, like lots of other tech stock ETFs. So it's the same package but different wrapping paper with a higher expense ratio. And if you're going to buy that, you might as well just stick with the S&P 500 because that has a lot of exposure to metaverse stocks like Nvidia and Facebook. Okay, so that's my opinion. But the ARC fund, the Kathy Wood one, and I got to tell you, I've said this before. I think Kathy Wood is a great saleswoman. It's salesperson. She's great at that because she says like, "Oh, I'm expecting I'm going to quintuple the assets in my fund in like X amount of years," or, "Oh yeah, that's yeah." People don't understand. Oh, they're this, they're that, and they're so great. She actually said in one of her videos, if you ever go on their website, like the Benjamin Graham principle of value and this, and like you're actually saying, quoting Benjamin Graham, the grandfather of value investing, and then you're going into your overpriced, hyped up, speculative tech stocks that were just winners because you were basically a good way to play the pandemic stocks. And you say that you try to make some weird connection from Benjamin Graham to your stocks, but it doesn't work. It's a cool thing to say. It's like I'm saying, the speed limit's 55 miles an hour on the Long Island Expressway, fact. And then I'll talk about Zoom and DoorDash, fact, undervalued. It's just a weird connection. And I don't think it's over. So that's my story. I'm sticking to it. Tough day for stocks, really tough day for tech. So the question was, do these smaller companies going down, does that affect the larger cap tech stocks? The answer is yes. Now, does the larger cap tech stocks affect the rest of the broad stock market? Judging by today, it's only one day, but yes, it does affect it. And if people start taking money out of these tech stocks, you can't help but see the major averages, in particular the S&P 500, go down because it is still so heavily overweighted in tech. And just like the biggest 5 stocks in the index represent something like 25-30% of the index. So that's where we are today. Michael is out there. BITO made me laugh. I appreciate being entertained while learning, Mitch. Dude, it is my pleasure. And Michael, thank you for being such a good friend. And it's good to see you out here. Follow Michael Gordon on LinkedIn. He puts out a lot of great content. Michael and I are part of a group of financial advisors and coaches who are just putting out, if I may say, great content, like on LinkedIn. Like every day I wake up in the morning excited to jump on LinkedIn to see the great content, the creativity that my friends are coming out with. It's really a lot of fun. All right, guys, I'll see you tomorrow. Thank you very much. Have a good night.